Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 278 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Good morning, Matt.
Good morning, Mark. How you doing?
Doing well. So inching closer and closer to Thanksgiving, which means we're inching closer and closer to Christmas, which means we're inching closer and closer to the end of 2024.
That's very true. You know, Thanksgiving's late this year. I got the bird already ordered. Pick it up this weekend. Going to get that bad boy brined.
Yeah, you're a deep fryer, right?
I'm a deep fryer.
Nice.
And this year, my wife listens to the podcast like every other, so we'll see if she hears this ahead of time. I found myself a Thanksgiving margarita recipe for her.
Nice.
It's a little fall-flavored margarita I'm going to surprise her with on Thanksgiving morning.
It's exciting.
Nothing like a little specialty cocktail to get the holiday cooking a little bit better.
Yeah, a little tequila to get your Thanksgiving started.
Right?
Yeah, great. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts and as of the market close on November 19th. S&P 500 index up 3.7% so far in November and up 24% for the year. The Dow Jones Industrial Average up 3.6% for the month and up 14.8% for the year. The Nasdaq Composite Index up 4.9% for the month and 26.5% for the year. The Russell 2000 Small Cap Index up 5.9% for the month and 14.9% for the year. And the Vanguard All World ex-United States ETF down 1.7% for the month and up 5.3% for the year. 3-month Treasury rate at 4.62%, 2-year Treasury rate 4.27%, and the 10-year Treasury rate at 4.39%. Moving on to big headlines, current events from the week, Matt. The only thing that I had was Nvidia reporting earnings tonight. So it's the largest company in the world from a market cap standpoint. So it should move the needle in one way or another after they report, after the market closes this afternoon.
Yeah, it'd be really influential for the technology sector and even the subsector of obviously semiconductors. I know the implied volatility, as it usually is on the higher end for a name such as that. So there'd be a lot of eyes. So
meaning, in plain English, it's just expected to move several percentage points after they report earnings.
Well said on Thursday. So tomorrow. So
Right.
We'll see how that goes.
Yeah, it's one of those. It's like I see the memes on X where there's a picture of a bunch of people riding in the back of a pickup truck. One of the people has their hand on the handle.
I love it.
And people have
Nvidia earnings.
Yeah, they could mess up the market or they could save it and make the run higher into the end of the year.
That one never gets old for me.
No,
Just the
doesn't.
usage of the meme never gets old for me.
I've seen that quite consistently over the past week.
Well played, X people.
Tweets, articles, and research from this week. First thing I had was an article from Adam Turnquist. He is the Chief Technical Strategist at LPL. This was back on November 14th, titled "The Dollar Reaches a Potential Inflection Point."
Okay.
So I would encourage everyone to go read this full article. It was really nicely written by Adam, but just wanted to highlight a few lines that I found interesting.
Okay.
He says, as the election dust settles, the U.S. dollar index has found itself at a fresh year-to-date high. The post-election rally of around 3% has been underpinned by rising yields, a byproduct of an improving domestic growth outlook and rising inflation expectations. Relative outperformance has been a big driver of capital flows into the dollar, especially when you compare the U.S. economy to Europe. Economic activity in Germany and France, the Eurozone's two largest economies, continues to sputter, which you've talked about on this podcast earlier this year. This has put added pressure on the European Central Bank to keep cutting interest rates, including about a 25% chance of a 0.5 percentage point cut next month. The potential for fewer cuts from the Fed and a more dovish ECB has been a big factor behind the dollar's advance over the past few months. Outside of dollar strength and rising yields, President-elect Donald Trump's decisive election victory and pledge to end ongoing geopolitical conflicts has reduced gold's safe haven appeal. An improving growth outlook has pulled yields higher as the market recalibrates towards a shallower Fed cutting cycle. In contrast, deteriorating economic conditions in the Eurozone have increased expectations for a more dovish ECB, putting added pressure on the euro. So typically, Matt, when we talk about a rising dollar or a strengthening dollar, it tends to put pressure on stocks. However, that hasn't been the case so far this year.
Correct.
That theme has been decoupled, so to speak. So I just wanted to highlight three other additional effects of a rising dollar for consumers and for listeners.
This is great because a lot of people never see this.
Right. So number one, rising dollar makes imported goods cheaper for U.S. consumers and businesses, which can help reduce inflationary pressures domestically. So I know that there's been a lot of talk about Trump adding additional tariffs once he gets into office. But with a stronger dollar, no one really is talking about how that should help inflation in this country because goods we get from overseas are going to be cheaper.
In plain English, the dollar goes farther.
Correct. Commodities like oil, gold, and other raw materials are often priced in U.S. dollars. A stronger dollar makes these commodities more expensive in other currencies, potentially reducing global demand and putting downward pressure on commodity prices. Also good for inflation, right? A rising dollar often coincides with higher U.S. interest rates, attracting foreign capital into U.S.-denominated assets. This can further strengthen the dollar. So we have seen rates turn back up over the past several weeks, even though the Fed has been cutting. But in my opinion, it's market participants pricing in stronger economic growth, maybe over the next 2 to 4 years, higher yields, and we'll see what happens with inflation. I think there's a lot of people on both sides that are saying, the Trump administration's policies are going to help inflation, and there's others saying that it's going to hurt inflation, and no one's really going to know until he gets into office and they start implementing a lot of this stuff, right?
Well said.
Just wanted to throw it out there. I'm sure people have heard about the U.S. dollar and what it means, but hopefully this helps clarify some things.
Yeah, one thing I want to add is the trajectory of cuts by the Fed, the way the market is kind of posturing right now is that the pace of cuts, of interest rate cuts by the Federal Reserve could be slower than if it were under, say, a Harris administration. I think that's kind of how the market's interpreting, for good or for worse. Just add that to it.
Right. And yeah, going back to what I was talking about with, the European Central Bank and the Fed, like we've discussed before, we want to see the Fed lower rates slowly and possibly even pause because, again, in our opinions, that's a signal from the Fed to the economy saying, or to market participants saying, hey, the economy is doing pretty dang well, right? And if you compare that to our counterparts over in Europe, if they have to continue to cut while we hold rates steady, I think it goes to show you who has the stronger economy, right? And another reason as to why
money's coming
over here, U.S. stocks continuing to outperform European stocks specifically and just international in general.
I always like that analogy of a patient in medicine, right? If you're pumping that patient full of medicine, they're not healthy, you're trying to make them healthy. The more medicine you pump, that should be indicative by the health of the patient, i.e. the economy.
Right. Next was an article from Bespoke titled "The Day After 2016 Redux." This was back on November 6th, the day after the presidential election. So they compare the market action from the day after the election here in 2024 compared to back in 2016 when Trump won his first term.
This will be interesting. I'm all ears.
So they say the underlying action in the stock market today looks remarkably similar to the action we saw on this same day in 2016. Again, this was the day after the election. The three sectors that are selling off today are the same three that sold off following Trump's win in 2016: real estate, utilities, and consumer staples.
Okay.
On the flip side, the three sectors performing the best today are the same three that performed the best in 2016: industrials, energy, and financials. While it may be tempting to pile into three sectors performing the best today because of Trump's victory, the three sectors that performed the best on the day after the election in 2016 ended up being some of the worst performing sectors during Trump's first 4-year stint in office. As mentioned above, financials, energy, and industrials were the three best performing sectors on the day after the election in 2016, and they're also the three best performing sectors today. Again, today being the day after the election. Energy, designated by the ticker XLE, would go on to fall 49% from the day after the 2016 election through the day before the 2020 election, while financials, designated by XLF, was the second worst sector ETF during the time frame, and industrials, XLI, was on the lower end of the performance pack. On the flip side, it ended up being technology and consumer discretionary that performed the best during the 2016 and 2020 elections, even though they weren't big standouts on the day after the 2016 election. Again, not saying that in terms of performance, the sectors are going to play out exactly like they did from 2016 to 2020 when Trump had his first term in office. But I just found it interesting that the same sectors the day after the election were the same three were performing the best and the same three were performing the worst. We'll have to wait and see. But, I think it goes back to the old saying that history never repeats, but it always rhymes. So it'll be interesting to see if we have the same type of performance from these sectors over the next 4 years.
Yeah, I think it's well said. Compliance hat on my side is, no recommendation for or against those specific, sector ETFs on those specific tickers. But I think it's great to show that relation. And I know it's something we'll kind of keep an eye on here with the podcast.
Yeah. Last thing I had was a tweet from Mike Zaccardi back on November 7th. Jenna will throw this up on the YouTube page. It'll also be in our show notes. But
ooh, interesting chart, Mike.
He says, following the election, the S&P 500 typically rallies through inauguration day before moderating. And what this graphic shows for people that aren't watching on YouTube, it shows about the performance of the S&P 500 about 100 days prior to the election and then about 300 days after the election. And specifically what Mike is pointing out here is the time after the election to inauguration day, the seasonality of the S&P 500 going back all the way to 1932 through 2020. S&P 500 and stocks tend to rally during that period. And it just goes to other things that we've talked about over the past couple of weeks. We're in the most bullish 6-month period of the year, specifically November through, I think it's the second trading day of the new year is the most bullish three-month period of the year. We have Q4 seasonality, holiday spending season. So this shouldn't really surprise anyone, but I did want to point this out that going back to 1932, stocks do tend to do pretty well after Election Day through the first couple weeks of the new year.
Great to put just it graphically there and overlay that over all these years. I think that's a wonderful chart by Mike.
That's all I had, so I will turn it over to you.
All right. First thing I want to do is kind of discuss investor sentiment, Mark. Lots of optimism right now after the election. So the first thing that caught my eye was a post by Sentix. They do a investment survey. I saw this post, Mark, on November 10th. Jenna will put up this chart for our YouTube viewers. This will be in the show notes and all of our social media sites. And what it shows is a chart that's going to go back a couple of years here. And it really just shows investor sentiment reached an all-time high. And the data set for this specific survey goes back all the way to 2001. So to make an all-time high going back that far is quite impressive. So I wanted to throw that out there first. Then to add to this, Mark, in a similar fashion, the Investment Managers Index Survey, the IMI, I saw this data coming up the first couple days of November. It surged to one of its highest readings ever and the strongest since the booming 2021 stimulus frenzy. And that source on that is S&P Global. And Jenna will put up that chart very quickly for our YouTube viewers as well. So it was interesting. I saw this and I thought to myself, why the enthusiasm? Well, the Sentix didn't break it down, but the S&P Global Survey did. And this is where I think the rubber hits the road is this next chart. So this next one coming up is what's driving U.S. equity returns over the next 30 days, i.e. Mark, why the enthusiasm? And what you're going to see here is a huge, huge shift in the political environment. So the market is, at least in the short term, anticipating maybe lower regulations, maybe a lower corporate tax rate. And I think that enthusiasm is why you might see these surveys the way they are. But obviously that stuff still has to get, and a lot of it has to get enacted by Congress. Regulation changes have to be, appointments within these various departments. Mm-hmm. There's still things that have to happen. But it's interesting to kind of see these major changes in sentiment. Let me pause. Thoughts, comments? Probably doesn't surprise you.
No, it doesn't. I just want to point it out there that, we have to remember that the market is pricing in the potential for a lot of these things from the new administration getting enacted.
Well
right?
said.
So if it does come where, if it's sometime over the next 6 months or sometime, within the next year or two where they are successful in lowering the corporate tax rate, they are successful in extending the Tax Cuts and Jobs Act that's supposed to sunset at the end of 2025, don't be surprised if at that point in time, markets are falling, right? Or they're in a correction and people are going to be like, why is the market going down? This should be a good thing for the market, right? Mm-hmm. The market prices these things in well in advance. And I would argue that just the potential for something happening in the future would generate stronger returns than it actually getting enacted.
You perfectly went over the point I was going to make. I have nothing to add to that. Well
Sorry
done.
to steal your thunder.
No, I prefer it. That was a TED Talk there. It was great.
And then the next one, it looks like, is they break it down by people voting on which sector outlook is the best for the next 30 days.
Yeah, sentiment on each sector of the S&P.
You have financials, obviously, with potential for a lower regulatory environment. That makes sense. IT, consumer discretionary. Mm-hmm. Obviously, if tax rates are down, then people are able to spend on things they want and not necessarily have to spend a large portion of their income on things they need. So that makes sense. So, yeah, interesting.
I have nothing to add. You killed it on that one. So my next one is a reminder of what I call clickbait headlines. I know pretty often we tend to talk about this topic on the podcast, but this post by Ben Carlson, Mark, and it was on November 2nd, just caught my eye. So I would like to have Jenna put up this post by Ben for our YouTube viewers, and I would like for you to verbalize a couple of these headlines. But when you do it, Mark, for me, please look at the date. And if you need help, I know it's a little small, I can help you. Mm-hmm. But I want you just to read a couple of these, read the date, and then we'll have just a 1 minute roundtable, okay?
Yeah. The first one, Paul Tudor Jones says that the U.S. economy is on an unsustainable path threatening markets.
Ooh, that seems pretty serious.
In February of this year, so February of 2024.
Got it.
And we know how the S&P has performed since then. Next was on October 10th of 2022, shortly before, we're talking a few weeks before the market bottomed in 2022.
Correct.
Paul Tudor Jones believes we are in or near a recession, and history shows stocks have more to fall. Like I said, that was a couple of weeks before the market bottom, so that's 0 for 2 for Paul, unfortunately. September of 2022, Stanley Druckenmiller sees a hard landing in 2023 with a possible deeper recession that many expected. 2023 was a great year for stocks, and that has obviously rolled into 2024. Mm-hmm. Next is, this was May 22nd of 2010. Legendary investor is more worried than ever. Hedge funder Dalio thinks the Fed can repeat 1937 all over again. And we obviously know what happened from 2010 through 2020, one of the strongest decades we've seen. So it's, people can get on media outlets and give their opinion on stuff, but that could be completely different from what they're doing in their own portfolio.
Or they can switch the next day and they're not going back on there and telegraphing.
I think, for an example of that, Paul Tudor Jones, I'm pretty sure he made his money. He was a trend follower, so he was like
he made his name in the 80s.
There was no discretion involved with his portfolio choices, meaning he wasn't taking into account what was going on in the economy to make buy and sell decisions. It was purely rules based based on price action, right? So, but if you didn't know that, and then you see him talking about the economy,
you would assume
like,
his portfolio reflected.
He's a hedge fund billionaire, so he must know what he's talking about. But I look at this and say, didn't Paul make his money, being a systematic rules based guy and not worrying about the economy or any fundamentals? So, yeah, we see it time and time again. We've seen it a bunch of times throughout 2024, and it just hasn't come true.
Yeah, I mean, and the moral of the story for me are these gentlemen that were mentioned, at least in this example by Ben, notorious and very successful investors? Yes. Does not mean that they have, our clients or these listeners to this podcast have the same time horizon, risk tolerance. There's a lot of factors at play there. And I just... time and time again, I will talk to people over the years, Mark, and they're like, yeah, I got out. I saw this headline. I really respect XYZ person. And, I wanted to kind of follow that. They made this call right and picked the year 2008. So I feel like that was in my best interest. And now the market's rallied. And now what do I do? Mm-hmm. So just word of wisdom.
Yeah, for sure.
So my last piece is perspective on the current bull market. On a couple of those pieces, Mark, they were near capitulation on the market bottom in October of 2022. This is a post by Grant Hawkridge. He is a part of the All-Star Charts family. And Jenna will put up this chart for our YouTube viewers. This will be in our show notes. One, I would highly recommend our traditional podcast listeners take a peek at. Why? This will show all of the bull markets or uptrends going back decades and decades. Mark, take 20 seconds. What's a bull market or an uptrend?
It's a 20% move to the upside from a low that's made, essentially, after a bear market, which is a 20% fall from a high point at any point in time.
And it remains a bull market or an uptrend until...
if you fall 20% from any high.
You got it. So this chart is visually showing you the length and performance of every bull market. And it's going back, you'll see the data set begins, I believe, in 1950 is where it goes back to. So I say every since 1950 to be very specific. And Mark, when you look at the bull markets visually, and then the one we're currently in red, how do you interpret this, sir?
Still potentially in the early innings of this bull market. 2020 was a short one, for example, so it can happen. I think it's important to point that out there. So 2020 looks like that bull market lasted between 460 and 500 trading days, which is obviously just a little over a year, close to 2 years maybe. But on the other hand, in 1987, that bull market lasted 3,083 trading days, it looks like.
And there were a lot that lasted over 1,000.
Yeah, and we're still in the 500s right now.
Yep.
So on average, I would say, yeah, there's plenty more time and room to the upside to run in this bull market. And, like we've said before, post-election years tend to be positive, not anything crazy, but they do tend to be okay. Midterm election years tend to be challenging for the market. So now we're talking about 2026 is a year potentially where stocks could struggle a little bit. Not saying it's going to be a full-blown bear market, but I would, if I was a betting man, I would say 2026 might not be as strong of a year as we've seen the past couple of years. I think 2025, as long as the economy doesn't go into a recession, I think it has the potential for being another decent year.
Well said. So that's all I have this week for our listeners and viewers, Mark. We should probably remind our listeners and viewers about our Blueberry promotion. We use them to host our podcast. And so, as a reminder, if you want to create your own podcast, use the promo code JessupWealth to get your first month of Blueberry podcast hosting for free. That is spelled BLUBRRY. You can go to their website, choose the ideal plan for you using their hosting estimator on their website. Again, you can receive your first month with promo code JessupWealth, all lower cases, no spaces. In addition, if you're looking for some AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. Jenna will put a link in our show notes, and you can look at purchasing your own subscription to make life a little bit easier. Mark, before we sign off from this episode 278, final thoughts, comments?
No, like I said, to start the podcast, I think a lot of the market action over the next week will be determined by Nvidia earnings tonight, fortunately or unfortunately. So we'll keep an eye on that. But like I said, performance between now and the end of the year tends to be pretty good. And typically we get a little dip the week before Thanksgiving in the markets before that ignites the rally between now and the end of the month and now and the end of the year. So it wouldn't surprise me if markets continued higher through year end. I think some people would be like, oh, they can't. It's hard. S&P's already up 24% so far this year. But I think we're going to have a pretty good finish to the year.
I echo those comments. And I'll finish it up with anybody wants my Thanksgiving margarita recipe, they can email me or they can email inquiries@jessupwealthmanagement.com. I'm a Swiss Army knife today for the podcast.
Perfect. Well, thanks everyone for listening to episode 278 of the Independent Advisors Podcast. We will be back with you next week for episode 279.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.